What if I told you a 5-year-old, with no experience, no strategy, and no clue about the stock market, just beat some of the smartest investors on Wall Street? No, this isn't a joke. It actually happened, and the results were shocking. So, how did a kindergartner outperform seasoned hedge fund managers? And what does this say about how you should invest? Stick around, because this might change the way you see the stock market forever. This all started as a joke. A friend of mine, let's call him Mike, is a financial analyst. He spends hours researching stocks, reading reports, and analyzing data. One day, during a family dinner, his 5-year-old son, Jake, overheard him talking about investing. Jake asked, "Dad, can I pick stocks too?" Mike laughed but decided to play along. He let Jake pick 10 stocks completely at random. No research, no charts, no strategy, just picking companies based on their logos, names, or whatever sounded fun. Mike wasn't expecting much. He carefully built his own portfolio using all his investing knowledge, valuation models, earnings reports, market trends, you name it. Fast forward 1 year later, and the results were insane. Jake's random picks outperformed Mike's portfolio. Not by a little, by a lot. Jake, plus 34% returns Mike, plus 7% returns Mike was stunned. How did his 5-year-old son, who knew nothing about stocks, beat him? So, Mike did some digging. And he discovered something shocking. Jake wasn't the first random investor to beat Wall Street pros. In 1973, economist Burton Malkiel suggested that a monkey throwing darts at a stock chart could outperform professional investors. In 2013, the Wall Street Journal actually tested this, and the monkeys beat many fund managers. Even legendary investor Warren Buffett has said that most people would be better off just buying a simple index fund. Why? Because most investors overcomplicate things. Jake's portfolio did better because he wasn't emotional, no panic selling during dips. He didn't overthink it, no endless research or analysis paralysis. He picked big, well-known companies and let them grow. Ironically, this random strategy mirrored what some of the best investors do. Buy good businesses. Hold them for the long run. Ignore short-term noise. It turns out, many Wall Street pros fail not because they don't know enough, but because they try too hard. So, what's the takeaway? Investing doesn't have to be complicated. Sometimes, simple strategies, like buying and holding strong companies, work better than all the fancy analysis in the world. So, the next time you're stuck overanalyzing stocks, ask yourself, what would a 5-year-old do? If you enjoyed this, hit the like button, subscribe, and let me know in the comments, what's the most unexpected investment success you've had?